All right, today we are tackling a question that's at the very heart of the economy: inflation. But what if I told you there isn't just one number for it? We're going to demystify the two key metrics that measure your cost of living and unpack why the difference between them is so crucial for everything from your savings to national policy. So let's dive in. So you see a headline, maybe it says inflation is running at, I don't know, 3%. But then you hear an economist on TV mention it's actually 2.7%. It's confusing, right? I mean, how can both of those be true at the exact same time?
Well, the simple answer is they both are. You can think of it like this. The U.S. economy has two different speedometers to measure price changes. One is the Consumer Price Index, we've probably heard of it as the CPI. The other is the Personal Consumption Expenditures Index, or PCE. They're measuring the same road, just in slightly different ways.
And here's where it gets really interesting. The CPI, that's the one you almost always hear about in the news. It's the one that drives market reactions and all the political debates. But the PCE, that's the number the Federal Reserve actually uses when it makes those massive decisions about interest rates. You know, the ones that affect your mortgage, your car loan, and your savings. Okay, so the single most important thing to get is this fundamental difference in what they measure. The CPI tracks the change in price for things you, the consumer, pay for directly out of your own pocket. Your groceries, your gas, your rent. The PCE, on the other hand, is way broader. It measures the prices of everything consumed in the economy, even if someone else is paying for it, like that health insurance your employer provides. And you know, this isn't some new debate. For decades, the Fed looked at CPI just like everyone else. But back in 2000, the Fed chair at the time, Alan Greenspan, signaled a major shift. The Fed realized the PCE offered a more complete, more dynamic picture of the economy. By 2012, they made it official. Their 2% inflation target is explicitly, and I mean explicitly, a PCE target. So why on earth does the PCE give a different reading? Well, it's not just one thing. The Bureau of Economic Analysis breaks the difference down into four main effects that create that gap. Let's walk through each one because this is where we really get under the hood to see how these two speedometers are built. First up, we've got the formula effect, which really just comes down to something called substitution bias. See, the CPI uses a fixed basket of goods. It basically assumes that if the price of beef skyrockets, you just keep buying the same amount of expensive beef. The PCE, though, uses a more flexible formula. It actually captures the fact that you'd probably switch and buy more chicken instead. Because of this, the CPI has a tendency to slightly overstate inflation. Next is the weight effect, and this is all about how much importance each index gives to different parts of your budget. In the CPI, which is all about what households pay for out of pocket, housing is a massive component. I mean, look at that. It makes up about a third of the entire index. Now, let's flip over to the PCE. See the difference? Wow. In the PCE, the weight of housing gets cut in half, all the way down to about 15%. And you see what expands to take its place? Healthcare. Its weight nearly triples. So why is that? Well, that brings us to our next point. It's all because of the scope effect. The CPI only measures what you pay for healthcare directly, so your premiums, your copays, things like that. The PCE, however, includes the entire cost of healthcare consumed, including the huge portion paid for on your behalf by your employer or by government programs like Medicare and Medicaid. This is a perfect example of that difference between out-of-pocket costs and total consumption. And listen, this isn't just some academic exercise. These different indexes have huge, real-world consequences. The Federal Reserve uses the broad PCE to steer the entire U.S. economy. But the Social Security Administration, they use a specific version of the CPI to determine the annual cost of living adjustment, or COLA, for millions of retirees. So for example, let's say the Social Security COLA for a given year was set at 2.8%, because that's what the CPI told them. Well, since the PCE typically grows more slowly, if it had been used instead, that adjustment would have been smaller. And that directly impacts the monthly income for millions and millions of Americans. So let's bring this all into the present. Right now, this gap, this wedge between the two numbers, is a major focus for economists and policymakers who are trying to navigate a really tricky economic environment. It has huge implications for when and if we'll see any relief from these higher interest rates. There are three big issues making the path back to 2% inflation, as the Fed likes to call it, bumpy. First, there's a huge lag in how housing costs are measured, and that keeps the CPI artificially high. Second, things like new tariffs could cause a sudden price shock. And third, there's this stubborn category of inflation that they call supercore, and it just does not seem to want to cool down. So what is this supercore thing? The Fed is absolutely laser-focused on it. It's the cost of services. Think about everything from haircuts to financial advice, but with that volatile housing component stripped out. Since it's less distorted by that big housing weight we saw in the CPI, the Fed sees it as a clearer signal of underlying price pressures. And yeah, it's been running stubbornly above their target. And you can see this reflected in the Fed's own forecasts. Often, you'll see projections where both PCE and core PCE inflation are expected to stay above their 2% target. When that happens, they signal what's called a hawkish path, with fewer interest rate cuts on the horizon, which, as you know, has major implications for the entire economy. Now, here's the great paradox in all of this. Even though we all know the Fed bases its decisions on the PCE, financial markets and the media still have this obsession with the CPI. So why in the world does the wrong number cause so much volatility in our investments in our 401ks? Well, it's actually a simple matter of timing. The CPI report comes out about 2 weeks before the PCE report. And in the world of high-speed trading, waiting 2 weeks is an eternity. This quote just captures the market mindset perfectly. Traders would much rather react to flawed data that's available right now than wait for better, more accurate data later. There's also a really important social dimension to all of this. A single inflation number doesn't affect everyone equally. Not even close. Research shows that over the long term, lower-income households have actually faced a higher effective rate of inflation. And that's because necessities like food and housing, which have seen faster price growth, just make up a much larger chunk of their budget. It really raises a key question. Whose cost of living are we truly measuring? So, after all this, which index is better? Which one is right? Honestly, that's the wrong question to be asking. The answer is that they are simply different tools, designed for completely different jobs.
So let's just summarize the key differences one last time. The CPI's formula can overstate inflation a bit, it heavily weights housing, and it only covers out-of-pocket costs. The PCE, on the other hand, accounts for us switching to cheaper goods, it gives a much heavier weight to healthcare, and it has a much, much broader scope, including all that stuff paid for on your behalf.
And really, that's the core takeaway. The PCE gives policymakers, like the Federal Reserve, a comprehensive bird's-eye view of price pressures across the whole economy. The CPI gives households and people on benefits a more grounded measure of the out-of-pocket costs they actually have to deal with. That gap between them? It isn't a flaw. It's actually a feature of a system that's using specialized tools for different purposes. Which leaves us with one final big question. We have one number that guides our national economic policy and a completely different one that determines the annual income for millions of people. What does the existence of this persistent wedge between the two really tell us about the complexities and maybe even the inequalities of our modern economy?